I think the number of searchers who go into it saying, I'm going to own forever or for a really long time, like how many of them end up actually doing that is a small proportion, right?
Guilty.
Yeah, exactly. Which is okay. Like, to be clear, it's like good to change your mind, right? When you learn something new. But I think like the pattern I see almost universally is that everyone gets into it with the idea that they'll hold for a long time, and then that holding period gets shorter and shorter the harder it feels to actually do it, which is totally reasonable.
And that's been my experience, by the way, actually seeing people own, having been investors in businesses, the hold is significantly shorter than what people planned.
Very, very few searchers I've talked to will say, hey, I want to own this business for a long time and I want to run it for a long time. Right? I think the much more common thing we hear is, hey, I want to own this business for a long time and eventually build myself out of it, right? Which is another way of saying, hey, I want to turn this into a higher quality business and make it less owner dependent, make it higher value. But then what's really happening for a small business owner like a searcher is their risk tolerance is shifting.
That's your game in the first few years, is to make the business just safer, less reliant on you, and ironically more valuable, and then you can pick whatever you want. The problem is a lot of us struggle to get there.
Welcome back to The Intentional Owner. We are recording, I think this is episode number 4, and it's going to be, in our planning document, the title we said is something about long-term holds and holding a business for a while. So that's what today's about.
All right. Well, Kaustubh, I'm not sure what long-term holds mean. Like, are we holding something? Are we trying to hold something? I think what we're talking about is that when we get into small business ownership, a lot of us come to it from the thought that maybe we'll do this for a long, long time. And that is as opposed to in private equity or institutional business ownership, there is just generally an expectation that ownership of a business will be for a few years at most. Private equity, I think, will tend to need to turn businesses over to a new owner in order to monetize and be good stewards of their money for their investors. So it forces them into a hold period, and a lot of us just align with a different approach when we first get into ETA. So I think we're going to talk about that today. I think I'm going to ask you most of the questions because you're the smart one here.
I don't know about all that, but I am down to talk about this because I have a lot of thoughts, obviously.
You come from institutional private equity, like the most institutional of Wall Street private equity. So is there something about that business, that line of work, that thought process around holding periods and kind of like how they typically hold them a lot shorter that had you aligned with the idea of doing something longer hold when you were to buy a small company?
Totally. I mean, I don't want to go like too much into the theoretical finance, but like indulge me for a minute. I think people have a misunderstanding where they're just like, oh yeah, private equity, they just like flip companies. Like what's like, they have no like long-term thought process or whatever, right? Like, I think people kind of misunderstand the like why it works that way. Like why do private equity firms only own businesses for 3 to 7 years versus, a longer term hold? And I think like the key understanding point is that people who give money to private equity firms to go buy businesses, they are asking the private equity firms to go generate a higher return than, what you would get on like a public company, right? So like if you're a big pension fund and you give, 10% of your capital to a PE and you give like 50% of your capital to public equity stocks, like just like, mutual funds, your expectation is that the private equity firm gives you a higher rate of return than the public equity. And so part of what's happening is like part of how you generate a return as a private equity firm is you take a business that was riskier and you make it less risky, right? And that allows it to go up in value and sort of basically change hands to an owner that's willing to take a lower return on capital. Right. So that's actually like the product of private equity is saying like, hey, we're going to go buy a business that currently is priced at whatever, 25% a year return. We're going to turn it into a high enough quality business that somebody with lower risk tolerance is willing to buy it and they're happy to only generate 10% return at that risk. And like that difference that they generate in asset value is the value they capture for their investors. That's the core point behind private equity. And I mean, venture capital is the exact same thing. They're just taking it from the startup phase all the way to a public outcome, right? Where it's a public stock, where like you would argue, hey, Google is now like a really safe stock, arguably, right? And at various points in its life cycle, from when it was a seed company to startup to whatever, it was at extremely different points of risk. And so the investors along the way had to keep changing. So private equity is a specific type of investor for a specific moment in the life cycle of a business. Whereas now, if we talk about small business, very, very few searchers I've talked to will say, hey, I want to own this business for a long time and I want to run it for a long time, right? I think the much more common thing we hear is, hey, I want to own this business for a long time and eventually build myself out of it, right? Which is another way of saying, hey, I want to turn this into a higher quality business and make it less owner dependent, make it higher value. But then what's really happening for a small business owner like a searcher is their risk tolerance is shifting. So rather than selling to a new owner that has a lower risk tolerance, they just become a new type of owner that wants a lower risk tolerance. And therefore, they're okay with the business being a lower return because they get their time back and they want it to be steady. So anyways, I kind of just rambled at you, but that's like my overarching like beginning thought here.
That being the case, did you not align with the product of private equity and the corresponding holding periods? Or did you come to SMB ownership just sort of irrespective of holding period in your own mind?
I mean, I definitely, at the time, we were selling a business that I really liked, but it was in fund one. We were onto fund three. Like, it was time for us to return capital to LPs. That's, part of what it is. And we had done the heavy lift of, the management team and the investment team had turned around the business, had grown it really nicely. And now it was a better asset for a strategic to own than a private equity firm. So we sold it. Right. And like, that was one of those moments where you're like, dang, like, I wish I could own that business for 30 years, right? And so I definitely felt that. And I think the interesting thing is that initially pushed me definitely towards self-funded search also, as opposed to traditional search.
Right. And that makes sense. So I probably have a little bit more of today you are in a position where you don't really have any kind of artificial deadline on your ownership. And I'm more in the opposite position. And I actually look at shorter term holds and the objective to sell to another owner in a few years, a handful of years, is honestly not as negative as the ETA community talks about it, because it's a forcing function in many ways. It creates a lot of discipline for those of us inside of our fence company. We on as before, we never really had an end game in mind. Now we have a clear end game and objectives and a strategic plan that we're building towards. It gives us a roadmap that we can lean on. And I honestly struggled when I was an SMB owner, a small company owner. There was none of that. It was kind of indefinite. There were 1,000 tasks. I did have sort of like a light EOS, but it was I don't know. I almost needed the discipline created by the whole period to, create some action. So I don't know. I kind of think differently about it too. So let's pivot a little bit. When you went out to actually search then, did you have an approach to a holding period at the start, or was that not part of the calculus?
No, it was. I mean, as I got better or as I progressed in my search, I started whittling down the cities I was searching in to only be a couple cities where I thought I might live long term, because I was sort of recognizing like, hey, like, I don't know if I'm going to own this business for a long time, but that would be a really cool outcome. And so I want to actually give myself the opportunity for that to play out, which means buy a business in a city that I actually could live in for a long time. Which is, partially what led me to end up back in Seattle where I grew up, because I have my support system here. But I was pretty upfront with investors at the time. And I'm curious as you're an investor, I'm curious what you recall of how I pitched you. And so maybe like this is just like the narrative I have in my head. Maybe this was less clear to you. So I'm curious to hear that. But the way I tried to explain it to investors is in a best case outcome, we really like this business and want to own it for a long time. There are scenarios where that's not the case because either we are only able to grow it for a little bit and we just don't see a better path to the business other than to sell it, or we actually don't like the business very much and we just have to figure out a way to pay down debt and exit. And so I told investors like, hey, there is a chance that I return cash flow as fast as possible, and there's a chance that I actually choose to just keep reinvesting in the business for a longer period, and like I want to be upfront about that.
I mean, that's pretty much exactly my recollection, which is that you had maybe the honesty or the transparency to say, I just don't know how this is going to shake out. I think a big part of what made you special is you were so well articulated about this could be short if it's going well or not well, and this could be longer if it's going well or maybe less well. But
Correct.
the idea that like you're going to be very opportunistic and we're all going to benefit from that decision making, which is if it's plowing a bunch of cash and you're happy, and then we're all going to make some, you know, good returns. That being said, like if it's going really great and, some roll up comes along and wants to take you out, you might go down that path too. And those were all okay.
Right. And it was just too difficult up front to be able to tell,
Yeah.
right? Like, I
Yeah.
don't, obviously, like, you have to give some ideas of how you would weigh the decisions, right? You want investors to understand how you make decisions, how you think about decisions.
Yeah.
But I didn't want to provide kind of an overly fixed view on what's going to happen here.
Yeah. So I guess I'll give you the out. You don't need to share like what's in your governing documents, but
Yeah.
did any investor ever ask you to structure liquidity rights one way or the other or both?
No, it doesn't exist at all in our governing docs. So it's truly open ended. The only version is if I want to raise more equity, existing investors have the right to participate pro rata to do their share of it.
Yeah.
But there's nothing around either forced sale from investors to me, from me generating liquidity for the investors. There's nothing around that.
Yeah. So I see that actually a fair bit, which is interesting. I thought about proposing to my own investors a long time ago in our first self-funded search, a put and a call right. And a put just being that investors could sell their equity back to me, the principal owner, and a call right where, I, the principal owner, could force, them to sell back to me. And I thought it was kind of like intellectually interesting.
Yeah,
It
I thought about
uh
that too. Yeah.
and then I remember I had a mentor who said that if I tried to include that, he would not invest regardless of other terms, because really what that mechanism does is it creates a situation where you have to negotiate valuation up front, and it's almost impossible to do that well. You have to negotiate the valuation mechanism or lack thereof now for a situation down the road that's probably not going to look like it does now. So,
That's right.
and then it's like, well, if you're subject to put rights as the owner, like it can put you in a really bad spot. Likely you're gonna, get it put back to you when you're cash constrained, and then there are problems. Or the other is like you're essentially taking a lot of the upside away from your investors, and that's just not what being an equity investor is. So
Exactly. The way I think about that, I forget if we talked about this or 2 weeks ago or whenever we talked about my episode, but I would love at some point to be able to go to the investor group and say, hey, we have some liquidity. I want to do a share buyback, right? So if you want liquidity and you want out, here is a multiple that I'm paying, and like you're welcome to exit here. And like it just goes into the business. And so everyone's percentage ownership goes up who doesn't want to sell. And all the people who choose to stay, they kind of understand like, okay, like we are in like cash distribution mode, or we're in, like long-term hold mode from here. So you sort of get to create this moment of like investors can opt in or out to being the new type of owner, to my original point. Whereas like all of my investors right now, they are self-funded search investors. And at some point, my ownership group should be more like high quality, lower middle market investors. And I want to give people the right to opt in or out to that.
Yeah, that's great. Which is another way of just saying it's a conversation when the day comes.
Totally.
And so I think I at least, maybe you could offer your opinion, but I see a lot of searchers really keen on structuring like a takeout right. And it's kind of off putting, frankly, because, here when I wear the investor hat, the idea is we're going to follow you in good times and bad. And, to sort of have the ability to be in this for a long time, which is my preference, taken away is kind of a misalignment.
Yeah, I mean, it's sort of the idea of like, is this equity or is this debt, right?
Yeah. Yeah.
Like investor equity in self-funded search deals is essentially it's like paid in kind interest, subordinated debt, and a little bit of common equity, right? Like
Yeah.
that's what preferred equity is at its core. It's a little bit of sub debt and it's a little bit of common equity. And so if you put a cap on that common equity part, you've effectively actually made it like two layers of sub debt, and the lower one just has a higher interest rate. Um, which again, I'm gonna get lost in the weeds of this stuff. I find that super interesting, of like how you model that, but nobody else is gonna find that interesting.
Come on, this is the
But
intentional owner. Of course they are.
yeah, no.
All
I
right,
do
so
want to
let's
go
get
back, Sam. Though, actually, I want to go back to one thing you were asking. You were saying about how having a private equity backer now gives you some discipline and direction, because that goes to our original concept of like, why are we doing this with our businesses? Like, what is the intentionality, right? Because I think part of what I've been working on for the last year or so is figuring out what are my series of whys for what I want this business to exist and do. And it's actually been sort of freeing for me that the why is not like double EBITDA and exit in 3 years.
And so you love the idea that you can kind of go build for however long it takes and see where you land whenever that is.
I think it's mentally harder, right? Because you got to go and like the actual goals are a little bit more amorphous. They're a little bit harder to measure. Like if we're being a good employer, right? Like yeah, you can kind of measure by churn, but people churn for lots of reasons, right? Like it's hard. It's hard to really measure. Whereas like if the primary goal is financial and like growth oriented, that's super easy to measure. Which is why I think like you're right. Like private equity backed businesses are often laser focused in that way, but I think it can be to the detriment of all these other potential whys.
Did your financial model, when you were raising money, did it show an ultimate sale? And if so, like when?
Yeah, it definitely did, because you just otherwise it like the model doesn't make any sense, right?
Exactly. Yep.
You have to show an exit, and so I think I modeled it out. I think 7 years, a little bit longer than like in PE we generally modeled 5 years, but in a normal PE deal you don't have like a significant J curve generally, whereas in search you do because of
Yeah.
the owner transition part. And so to me it felt like 2 years of transition and then 5 year hold effectively.
Got it. I always did 10 because I thought anything shorter was arbitrary. And at least if we're going to be arbitrary, we should be the same term as our SBA loan. So
Right.
does that
Oh,
make
that's
sense?
interesting.
Probably
That does
not.
make sense. I mean, what I kind of like about that, right, is if you do it that way, you can show a true exit cash flow yield, right? Because without a sale, I mean, right? Because you can say basically, hey, like at the end of 10 years, debt is paid off in theory. And so that means like whatever your cash flow is divided by your initial equity, like that is your ongoing annual cash yield.
Yep.
And like that number is going to be super high in any self-funded search deal if you can
Yeah.
actually take it 10 years and like hold EBITDA flat.
Yeah. It's clean for the model. I also, every once in a while, will think, remember the buyer in 10 years, when it shows the sale price on your model, doesn't have to be a third party, right? You could be recapping the business yourself
Totally.
potentially. So anyway, it's just interesting. All right, but you're 3 years in now. So now that you have been in the seat for 3 years, what are your thoughts on holding periods in general, and
Mhm.
for Blooma in your case in particular?
I think the number of searchers who go into it saying, I'm going to own forever or for a really long time, like how many of them end up actually doing that is a small proportion, right?
Guilty.
Yeah, exactly. Which is okay. Like, to be clear, it's like good to change your mind, right? When you
Yeah.
learn something new. But I think like the pattern I see almost universally is that everyone gets into it with the idea that they'll hold for a long time, and then that holding period gets shorter and shorter the harder it feels
Yeah.
to actually do it, which is totally reasonable.
And that's
Um,
been my experience, by the way, actually seeing people own, having been investors in businesses, the hold is significantly shorter than
right.
what people planned.
Yeah. I think for me, I would have answered this question differently like a year and a half ago. I think a year and a half ago, I was like, ugh, this is hard right now. Not that it's not hard today, but like each day is feeling like a grind in a way that makes it hard to imagine me holding this for 5 more years. And so it felt more like I have to figure out a way to grind this to be able to get out. Whereas I think sitting where I am today, it feels like, hey, like we've got a long way to go, right, for this to be a financially successful outcome for me or for investors. But the day to day experience of it is much more enjoyable. And so now it's like, okay, I can actually imagine doing this another 3 years, 4 years, like however, whatever it takes. So I think it's a little bit more the hold period. I guess the broader point I'm making is like hold period seems a lot more driven by searchers' experience of running a business, right? Than the like theoretical what you actually want to do with the business.
And ironically, to say another way what you were trying to describe, as you make the owner's job easier, less stressful, the business less owner centric, you make your job easier, your life better, maybe more willingness to hold it for a while. You also make it probably more valuable, the business itself, which makes
Right.
it more financially rewarding to sell it in shorter run. So I think in creating that sort of interesting, optionality, that's your game in the first few years, is to make the business just safer, less reliant on you, and ironically more valuable. And then you can pick whatever you want. The problem is a lot of us struggle to get there. So
For sure. I mean, the actual path to doing that is difficult,
yeah,
right?
yeah,
But no, exactly. Like, I would love for the outcome to be that, like, I am in this higher risk mindset for a few more years. And then when I'm ready to be in a lower risk mindset, like, the business is actually lower risk.
yeah, totally. All right. So then you also wear the investor hat occasionally and look
Mhm.
at other searcher acquisitions. What do you look for? Regarding holding periods, maybe like in particular, and then like communication wise, what are you looking for generally?
Yeah, I'm pretty agnostic to holding period from as an investor. This is not an area that I'm expecting liquidity, right? And so it's sized appropriately to my overall investing, which is sort of like everyone has to figure out what that is for them. It is funny that there was one deal I did where the searcher raised some debt along the way from the investors, and my dad participated in that, and I didn't because I was like, okay, I don't want a 1 year like interim debt facility. Whereas my dad was like, oh, great, like he doesn't like want to get his equity stuck in a long term thing. So he was pumped. He got a 15% 1 year note, which was great. It was like such a clear example of like, oh, we have different liquidity preferences, we have different risk tolerances, right? Because he is whatever 30 years older than me and at a different part of his life. Um, and so I was in the equity of that deal, and he came in as one of the lenders,
That's
which is kind of
hilarious.
fun.
That is
But yeah, no,
hilarious.
yeah. But when I'm in the I think I care a lot more about how the searchers are communicating and how they're thinking about the deal than I do about the actual plan for liquidity or hold period. What
Same.
about you?
Uh, identical. Um, like highly emphasize the communication because it's good insight into how, folks are thinking about their life. It's a sign of maturity. It's a proxy for maturity and
Mhm.
clearness of thought in people's minds. I think the reality is that nobody has any idea how it's going to shake out. So it almost has
Right.
nothing to do with exactly the decision around what's the whole going to be. It's all around how they articulate it.
Have you gotten any can you think of an example of like a bad answer or like a poorly thought out explanation?
Searchers do this a lot. They'll refer to raising equity as giving equity away. They will use that phrase often and sort of like without thinking about it. Hey, I'm I'm going to give away this amount of equity, and I just think that when they say it and they don't realize it, what it means about their feelings regarding investors is, for me, usually a great way for it to be a quick no.
Nice.
So that's one thing that's kind of unrelated. I'd say, like, I probably would never do, I say, because I've never done like a deal where there's some kind of call right. Um, I think I align with my old mentor's approach there, that I want to be in this for the long haul and take the risk and be paid for it if it's rewarded. So I don't think I would ever do that either, is get into a deal with like a structured buyout. I might be in one or two. It's been a while and it's been a lot of them. So I think we all have to choose like how we are investing for the long haul and our various things we do. I love investing in searchers in kind of smaller amounts, in
Mhm.
more of them, because that the illiquidity that we're taking, that risk, I think is going to pay off by being in enough of these small business acquisitions over the long haul. So it's kind of like a barbell approach, I guess you'd say.
Right. And I guess what would you say if a searcher came with a pitch that was like, hey, found a business that is being really mismanaged, but I think has a lot of potential. I want to do a 2-year turnaround and exit. Like, would you back that type of deal?
Yes, I love that. I think it would be even more highly dependent on the operator,
Of course,
because
yeah.
in distress turnaround situations, like, you have to create a hair on fire atmosphere and just light everything on fire and have crazy urgency. I say that because I have no hair and I've been in two turnaround situations personally. So it is a different dynamic. That being the case, that's super interesting. The problem, of course, is like those opportunities, you can't use leverage, right? So they're like, the financeability of them is unique and harder. But yeah,
Right. But you wouldn't be turned off by somebody saying, like, hey, I'm trying to be here for 2 years and then I get out.
no, not at all.
Yeah.
That's
Cool.
cool.
No.
That's a good idea.
Yeah. That's actually just clarity of thought.
Yeah, exactly.
Yeah.
So I had this in our notes. Like, are we overthinking this all together? Are
Yeah.
holding periods just something we should quit talking about, and folks should just get in the seat and figure it out? Just create the best business they can and figure it out?
I mean, I feel like it goes to what you were saying about what you expect searchers to say, which is like there is value in being thoughtful, even if it ultimately does not actually like real life is going to be what it is, right? It's sort of like the same question that like sometimes searchers ask, like, hey, like, should I really care about purchase price? Like, as long as I pay less than 5 times, like, what does it matter? And it's like, okay, I don't agree with that, right? Uh,
Yeah, it's true.
so just to change gears a bit, I'm curious, like, you've now done a couple self-funded searches and you've now done this commercial fencing roll up, right? And I'm curious, when you launched the first acquisition of this roll up, at that point, what was the thesis on hold period? And then what does it look like today now that you've got a private equity backer?
When we started, we were more thoughtful about the business we were going to build. And whether it took us 3 years or 5 years or 7 years or whatever, we we were going to go out and we were going to do our best to build the business we wanted to build, which is kind of funny now, mostly a Florida focused commercial fence installer, fence gate and automation that could service any commercial customer kind of no matter where they were in Florida. And we thought, maybe there'd be a day we'd scoot into Georgia or the Gulf Coast, and we thought, transparently, we thought if we did that well, we'd probably build to 10 million of EBITDA. And that would be a great business for us. And our economic incentives they looked more like a private equity investor. We were an independent sponsor. So ultimately, because of that economic structure, we had to sell or refinance, recapitalize in order to get rewarded for that performance. So yeah, that's how we went into it. We were not really super, thoughtful around how fast we would do it. We just wanted to build the right business. And then, like we've talked about, you get in the seat and you realize all sorts of things, how hard it is, how many people it's going to take. We also realized how big the opportunity was, and there was nobody else really doing it. So we ended up getting to where we wanted to be a lot faster. And then we decided to take a risk to leave Florida and go build a sort of a Southern US focused installer. So kind of a totally different business, same strategy, follow commercial customers around to make a project-based business, more of a repeating revenue,
Right.
or repeating customers. And yeah, so that was us prior to recapping with our private equity sponsor. And again, like I enjoy the discipline now of knowing
Mhm.
we're probably not going to own this for 7 years, And I like that. I don't know why.
What about in the first iteration? Like, what if it had taken 7 years to build just the Florida vision, right? Or something even smaller than that? Like, would that have felt like not it wasn't a good use of your time or your energy? Because it's a meaningful, like, you could have chosen to do a lot of things when you started that, the
Yeah.
roll up. Like, I'm
Yeah.
curious, like, obviously this worked, so that's great in terms of dollars per time, like year spent, so to speak. But did you enjoy it enough that you could have done it for 7 years?
I think so. So it was really my first foray into building a bigger business. So I
Mhm.
really enjoyed that. It was multi-location, multi-service. It was fun. I honestly was having experiences building that business I had never had before. We have a really great team that I enjoy working with. They're fairly young. We're all, we very much align on the strategy that we have. And so we were always having fun. I think if we only ended up staying in Florida and it took longer, we would probably also be doing things a little differently. We'd probably be more into access controls, which are
Mhm.
much more of like a local technicians and trucks business that is
Right.
hard to be a national business. So I actually think our business would look a lot different if we were going to be in it for 7 years just in Florida.
And how did you structure your personal role within the company to be different than when you were doing your own self-funded deal with your brother, right? Like, because parts of that you didn't enjoy. And so I'm curious, like, you decided to kind of get back into the driver's seat, obviously at a different scale, different type of business, all of that. But did you try to like put some guardrails in place to make sure it'd be more enjoyable?
Completely. So stepping back from those first few acquisitions as a searcher, the thing I didn't enjoy and I don't think I was great at was the people management component.
Mm.
Number one, I think it really, I've thought a lot about this over the years. I think what was hard is I wasn't great at prioritization. Maybe that's why I enjoy having a private equity sponsor, is because they
Right.
force function the prioritization. And so I would walk in to work every day, like kind of metaphorically, with this long to-do list. I had no real good ability to prioritize which of those things I was supposed to be doing. So I would get behind. And then, you know how people management works? It's never scheduled, it's always fire drills. And so I think I meandered for a couple of years, just kind of struggling with time management, prioritization, all those things when I was a capital constrained, people constrained small business owner.
Right.
So I fundamentally shifted that as an independent sponsor. When we bought our first fencing business, it came with two, well, I say two, but two of our partners who sold it to us and stayed with us as CEO and head of sales, but an incredible team. So really my responsibility for keeping the daily train on the tracks was minimal. Like it was almost nothing. And so I was able to work entirely on the business. So not just acquisitions, but all sorts of strategic planning and strategic execution projects that I'll bet you wish you could spend more of your time on, and you will. And I just made sure that
Mhm.
I bought into an opportunity that started there.
Right.
And I would joke all the time that my job for the first 3 years was like head of special projects and M&A. It
Pretty cool.
was fun.
Yeah,
So
I
it
mean
just,
that's where like it's interesting because I think you would characterize yourself as less of an operating guy and more of a deal guy.
right.
But like if you're doing that role in a business, like that you are operating, right? It's just a
Yes.
different part of operating. So you really just found the role for you within
Yeah.
operating.
Have you scratched that itch at all at Blooma? I say I know the answer, but talk about that.
I mean, yes, right. We've done 2 add-on acquisitions, which one was pretty small, but the first one, which was a little bit bigger, really, it more fundamentally changed our internal structure and our org chart. I really enjoyed it, frankly, right? Like I enjoyed going through the deal process. The I I remember talking to one of our other investors, Bradley, and when I was sort of like, "Hey, this is feeling hard, but I'm keeping this. I think this acquisition is a good idea." And he was like, "Look, man, like most people, when it was this hard, would have dropped the acquisition as the first thing. You clearly enjoy it enough that like that's actually giving you more energy to do an acquisition than the day-to-day ops." So I was like, "Okay, that's actually an interesting signal in terms of what kind of gets me going, and also just where my relative kind of edge is." You know what I mean?
Yeah,
Um,
totally. So can I poke there just a tiny bit?
yeah,
And
please.
as you de-risk your business and pull yourself out of the day-to-day responsibility of keeping the business going, do you think you'll spend more time on M&A? Like, do you enjoy that role in this industry enough to say, all right, maybe I have the P&L now to afford to hire myself out or most of my role out. Now I can go do M&A. Is that on your radar?
Yeah, no, it is. I think the part of the business that I really own and am accountable for right now is organic and inorganic growth, right? And over the past, I mean, I was always accountable for that, but I was also accountable for everything
Yeah,
else.
50
And so
other
I
things.
just, yeah, exactly. So like with the hiring of an operations manager who is better at the other stuff than me and enjoys it more than I do,
Yeah.
right? Like it's a better experience for our crews. It's a better experience for our clients to have her running that part of the ship. And that means I can be accountable for growth. And like I'm getting the organic side continues to be hard and I'm still working on how to like gonna drive organic growth. But inorganic growth, I like that's fun, right? You need to find good deals that actually make sense and fit in, right?
Yeah.
Like I'm not doing a roll up, right? I'm not trying to just bolt on revenue and EBITDA. I am trying to find like acquisitions that make sense for our business. But that actually like well, that works for me, right? It like makes it the acquisition strategy feel more intentional. It makes it feel like, hey, like does this actually make sense for what we're trying to build at Blooma? As opposed to like just building a financial asset. And like that complexity and nuance is enjoyable to me.
And that's a lot of what I enjoy too. And I would say it's so much more fun than I expected to be building a business that is growing organically, which gives you the balance sheet firepower to go, do inorganic revenue growth through acquisitions. That is fun because you have a bunch of background in deals. So that feels easier than learning some new work stream in your day to day at Blooma. And then it forces you to rethink all sorts of things like the organization itself. It sort of blows your mind. Every year or two, you have to sort of restructure your whole business to support M&A, but it's so
Mhm.
fun. It's interesting and it builds a ton of value too, which is great.
Totally. I mean, now that I have a clearer vision on like a 2-year basis of what this company should look like I can actually look at M&A as like, how does M&A fit into supporting that vision?
Yeah.
And then at some point, we'll get to that vision and then we'll reconstruct a new vision. And then, again, we'll think about how does M&A support that or not. But like right now, I feel pretty confident that like the vision that we have for the next couple of years and even longer around building an enduring tree care business, like that will be supported by M&A if done well, right?
Yep.
And so it's kind of cool for that, like to be something I think I'm good at, something I enjoy doing, and it's aligned with what we're trying to do with the business. Like I mean, that's all you could ask for.
Totally. And that might give you a bunch of longevity to do this for a long, long time.
Totally. I mean, part of what I'm curious, right, is it is really hard for a 2 to 4 person tree company to sort of transact, right?
Yeah.
Like where do they sell? Like they're
Yeah.
not going to sell to a searcher. They're not going to sell to a private equity firm. They're too small. But these are good arborists. They do good work. They have client base that really like them. Like to me, creating a basically like creating a comfortable landing spot for that type of business where the arborist gets to retire, they get paid for the brand they've generated, but they also get to feel like their clients are taken care of. If they have employees, those employees get to go into a strong organization. Like that's something differentiated, right? That we could build in the Northwest or in Seattle that, hey, like as arborists retire, like what do you want to happen to your business? Like I would love for it to feel like people just want their business to be part of our mission and vision.
So I don't want to spend too much time on this because this podcast isn't meant to be about deals. It's meant to be
Right.
about, being intentional about what we're doing in our careers via ETA. But I would say I have enjoyed, and it sounds like you do too, I've enjoyed doing acquisitions from the perspective of like the company you own as an insider where you know the platform you're buying from so much more than doing deals kind of ad hoc, different industries that have nothing to do with each other, like no fit whatsoever to it. It's just a lot more fun.
Totally. I mean, just thinking through like, hey, like, okay, that's where their yard is and their equipment. Will their equipment fit into our yard? Should we have 2 locations or just 1 location, right? Like these are business problems. They're not actually like deal problems, right?
Right. Yeah.
So to speak. And so it's the marriage between how do I want my business to look and feel and run and deal work is pretty interesting.
Totally. All right. So what do you say we wrap? We like to do a couple tactical questions just to conclude. Although first, I'm going to do a little bit of promo and
Please.
say that we are going to go to Dallas for SM Bash in about a month. And you and I are going to get on stage and we're going to do the Intentional Owner live. Is that fair?
I think so.
And I think what we're going to do though is bring a few guests on. So some friends of ours who own small businesses and kind of run them through the meat grinder that we've been running for each other here and see how they think about their own small business ownership.
Yeah. And I want to really push them on like, why are they doing this? Right? Like this is hard. They're all smart people, really driven. They could do I'm sure, a lot of different things in life.
Yeah.
So I'm actually less curious to understand kind of the path that they took on to get here. What I'm curious to understand is like where they are today. Why are they doing this? Like what is the goal? What is the purpose? So anyways, if, I'm really excited to do that in Dallas and actually like get to hang out with everyone in person.
For sure. All right, so let's wind it down with a little tactical Q&A. So I always think a lot about the tools that small business owners use and maybe less so like super, super tactical, but like big picture stuff. So do you use any strategic planning tools like EOS or something else, or do you totally wing it?
I've read a bunch of them,
Yeah.
and so I've sort of borrowed bits and pieces, but I'm not using one defined one for the business, no.
Do you have like a support group of any kind, a peer group? Um, there's lots of these around the country, but do you have any of those that you're a member of?
Yeah, so I'm in a peer group that has been around. It started as a searcher group, and has transitioned to being a owner group. And at one point, one of the guys, CEO coach, she basically started moderating it for us to make it a little bit less of a vent session and more like productive. So that's been really great.
Therapist to coach.
Exactly. So I have that. We meet once a month and I find quite helpful. And then I worked with a business coach, Rory Tyre, who's in the community. I worked with him for kind of a 6-month engagement last year, which helped a lot with defining my personal mission, defining the company mission, and then a couple other more medium-term strategic stuff.
Cool. And then a weekly therapy session called the Intentional Owner.
Exactly. This is a crucial element now. But I mean, hey, actually, now that I think about it, like another one, I do a monthly call with another searcher friend who, he bought his business and we just go through each other's financials for the month. And like,
really?
Yeah, one of the benefits of that, we have similarly sized businesses. His is commercial landscaping, so it's a little bit different, but pretty similar. But one of the benefits is it's like, hey, I got to get these financials closed so I can show him how things went, right? It's a little bit of external accountability.
There you go. All right. So we
Yeah.
both have a little bit of that hanging over us right now.
Exactly. I mean, look, the calendar invite fell off the calendar by accident for January, February, and my January, February books are not closed. And like, that may or may not be correlated.
Definitely. Definitely.
Yeah.
All right. Well, that was a fun conversation. We will call it a wraps and see everybody next week.